From the City of London for our audience worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, global central banks upending valuations.
These central banks have locked themselves in.
Extraordinarily low rates for a very long time.
We've got unprecedented low interest rates.
You are going to see larger and larger allocations towards equities.
Investors have gotten a bit aggressive.
I've seen a big kind of amount of what I would probably call irrational exuberance.
Unprecedented multiples.
Valuations are high.
By discounting cash flows at zero government bond yields or very, very low corporate bond yields, you are literally inflating the valuation of assets.
It's certainly more uncomfortable to sit it out.
You don't have many alternatives.
In terms of yields, it's hard to really see them certainly back up.
That's part of the ECB objectives as well. You want to push people out in duration and in risk.
Effectively, the ECB has stepped in and is doing yield curve control.
The idea that this monetary accommodation is going to create an inflationary wave and kill the bond market.
There is no alternative.
How many times have we heard that in the last few weeks? In fact, the last decade, there is no alternative. Joining us now, Troy Gayeski of SkyBridge Capital. Troy, great to catch up with you, sir. I asked this question earlier. I'll ask it of you. To read this market right now, do you need a PhD in economics and finance or a PhD in psychology?
Yeah, I think psychology, right? Or just understanding, how powerful Fed balance sheet expansion and money supply growth have been and continue to be, since they started ramping things up in March and April at unprecedented rates. It's not that simple, but it is that simple to some extent. And that when you look at assets across the board, and, one of the questions you guys had is, do you want to be up in quality or down in quality? Well, think of the name of your show, Real Yield. Like, there is no real yield, right? In anything high quality, right? And the bias is to higher rates over time. The Fed's going to fight it tooth and nail. The ECB is going to fight it tooth and nail, but very hard to make money in duration. However, if you look at, lower credit quality credits in RMBS or CMBS, you still have meaningful upside. And even though we don't expect significant multiple expansion from here, there is a chance that equity multiples expand 1 or 2 turns next year into better earnings just because of all the money that's been pumped into the system.
Let's get you to your structured credit call in just a moment. When we started the show a number of years ago, there was a real yield. It was a different world, Troy. The world we're in right now, I just wonder, you hear programs like this on other networks, on this network, talking about valuations all the time. Troy, how do you benchmark valuations against what to understand what's appropriate when we have a fixed income universe like the world has never seen before?
That's right. Yeah, so that's why any comparison to history is always a little bit dangerous, because when you go back and look at the late 90s, for instance, the last time you had multiples here or even materially higher, we got up to 25 times the S&P. Yields in the 10-year were 4 or 5%, right? Or it's slightly lower at times, slightly higher at others. Now we're at such low levels. Again, that should go up over time, but go up maybe 1.5 at the end of next year. So that's why you more than likely will continue to see spread tightening in assets that are tied to credit in different asset classes. And even at 21 to 23 times multiple or earnings next year, you could see further expansion. That's not our base case, but it's certainly a possibility. And it's not only a function of discount rates, right? That's very important. It's really a function of money supply. And, that's one of the points we've made since the bottom. We now have 25% more money supply in an economy that at the end of Q3 was still 3.5% below its previous peak. That level of money supply growth relative to real economy is truly unprecedented. And where it inevitably flows is into asset prices and causes first asset reflation and then further asset inflation.
So you've got a scarcity of safe assets, a scarcity of income, and you've got the same choices you've always had. Go further down a capital structure, take on more risk, take on more duration risk. Now, Troy, you don't like the duration trade in credit. Troy, can you just walk me through that and tell me why?
So look, if you look at IG or high yield, you're still not back to the post-GFC tights, but you're getting very close there in terms of spreads. But you're starting at so much lower of an absolute yield, right? So you just take the 10-year, for instance, right? We got down to 50 basis points briefly. We've worked our way back up to 90. you'd have to say the next 6 months, you're probably going to be in a 75 to 110 basis point range. But then when you look out to the end of 2021, the combination of existing fiscal stimulus that's yet to be spent, more than likely, again, and we've talked about this before, at least the McConnell style $500 billion, if not $1 trillion plus over the next 6 months. The fact that the vaccine should be distributed broadly by at least the summer at the latest, you're talking 1.25 to 1.5. And so, that's going to be gravity that you're fighting in the opposite direction, as opposed to which was your friend in February and March, as yields were gapping down. And then furthermore, one of the issues for investors is you don't have yield, but you also don't have the hedge value that you used to, right? Because again, you're starting at such low yield levels. So, September and October was a great example where equities were off, not a ton, but 6.5%, and the Barclays Ag was off 50 basis points. So, duration in general, we think is going to be very tricky for at least the next year or two as global economies continue to rebound from, the pandemic.
Troy, your message sounds pretty clear. If you want to take corporate risk, go all the way to the bottom, take the equity. Is that the story for you?
I think if you're just looking at pure corporate risk and you have no other choices, live with the mark-to-market volatility in equities. You look at that, that September 1st to November 30th period. You didn't actually make as much as many people think. You're up about 3.5%, even after the monster November rally. And you had two, mini corrections along the way. So you're paying a much higher volatility price now than you were coming off the bottom. But at least you have a chance to make money. In terms of other places you can put capital, there are still some pockets of inefficiency and opportunity in more complex credit. But in terms of vanilla credit or high yield, high yield, you're just not going to make much money. You still have defaults that have to work their way to the system. And you're very negatively convex again, right? If we do get this flare-up turns out to be much worse than people think, or you have some type of non-event in terms or non-follow-through in terms of fiscal stimulus, you could have spread widening, and you're not going to have that much upside at this point.
I know you're very constructive on areas of structured credit as well. I wanted to finish on this with you, Troy, though. I want to work out what the circuit breaker is for the behaviour we're seeing at the moment. The situation we're in right now, the dilemma was inevitable. The deeper you get into December, infection rates go up, restrictions come on. The vaccine's about to start to get rolled out, but we won't really see the benefits of that for the global economy until maybe the end of Q1, the start of Q2. Got to get to the other side. You've got a fiscal programme in between. That seemingly isn't enough to damage risk appetite. And I explored this earlier in the week, that this market right now, we seem to value it more. The more it goes up, and people are more uncomfortable sitting out than they are getting involved. That's a real behaviour, just self-fulfilling cycle, Troy. And I'm trying to identify what you think would break that cycle. What do you think would break that cycle? What's the circuit breaker?
So it's hard to point to one individual catalyst. But for instance, let's say we go through the lame duck without a stimulus deal, which is looking increasingly likely. And then you get into February, and it's apparent that McConnell still doesn't want to play ball, assuming the Republicans hold the Senate and he and Biden can't work something out that are mutually agreeable. That could be one key where the assumptions of additional fiscal suddenly disappear. Because remember, people have been waiting for fiscal stimulus since August and September, right? And now you're talking February, and if that falls through into March, that could be one circuit breaker. Another circuit breaker, which we don't think is likely, but is entirely possible, is if the Fed once again allows money supply growth to start trailing down to 5%, 6%, 7% levels, which we got to briefly in July and August after they just jacked things up tremendously. So if you see money supply growth the next 3 months start to slow into that mid-single digit level, that is going to suck the oxygen out, or the helium out of this balloon rather rapidly. And so that would be another catalyst for a risk off. It won't be to the day or to the week, but very similar to what you had in the back half or the Q4 of 18, that was a purely money supply tightening, Fed liquidity driven dislocation when the economy was doing well.
Yeah. Troy, always looking sharp, always looking cool. It's great to catch up. Send our best to the team at SkyBridge, won't you? Troy Gayeski there on the latest in this market. Let's get to the final spread the week ahead. Coming up next week, US industrial production figures coming up on Tuesday, then a busy Wednesday. US retail sales followed by an FOMC rate decision and Chairman Powell news conference. Another round of jobless claims on Thursday, and then the Bank of England and Bank of Japan rounding out the rest of the week with rate decisions. On the schedule, the last really busy week of the year 2020. We'll see you next Friday, 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg TV.